The biggest factor in choosing between a vertical spread and an iron condor isn't the profit potential. It's whether your market assumption is based on price direction or volatility contraction. Many traders get stuck trying to force a strategy onto a chart, rather than letting the chart dictate the strategy. The choice between a vertical spread and an iron condor comes down to one fundamental variable: directionality. If you have a directional bias, you lean one way. If you don't, you lean the other. Let's strip this down to the mechanics. A vertical spread is a directional play designed to profit if the stock moves in your favor or stays above a certain level. It consists of buying one option and selling another at a different strike price within the same expiration month. Conversely, the iron condor is a neutral strategy. You are essentially betting that the price will stay within a specific range. It combines a bull-put spread and a bear-call spread, creating a profit zone between two break-even points. The iron condor profits from time decay, known as theta, and a decrease in implied volatility. You don't need the stock to move. In fact, you want the stock to do absolutely nothing. It is a pure play on reversion to the mean or stagnation. However, the math changes significantly between the two. With a vertical spread, you are taking a 50-50 probability shot on direction, but usually collecting a higher premium relative to the capital deployed on that single side. Your defined risk is clearer because you only fight on one front. Now, here is where most beginners fail. They choose the iron condor simply because it collects more total premium. But remember, the iron condor exposes you to risk on both sides of the market. If the market rallies hard or crashes, you can be tested. To choose the right tool, you need a decision framework. Step 1 is analyzing implied volatility, IV. If IV is low, premiums are cheap, making short iron condors less attractive because the credit received doesn't justify the double-sided risk. When IV rank is high, option prices are inflated. This is the ideal environment for an iron condor because you can sell strikes further away from the current price, creating a wider margin of safety. You are selling fear when fear is expensive. Step 2 in the framework is your directional conviction. If you see a clear support level and believe the stock will bounce, a bull-put vertical spread is superior. Why cap your upside with a bear call side, turning it into a condor, if you are bullish? Let's discuss the probability of profit, POP. Generally, an iron condor has a higher probability of profit than a directional vertical spread because the stock can go up, down a little, or stay flat, and you still win. But this comes at a cost. The cost is the risk-to-reward ratio. In a high-probability iron condor, you might risk $400 to make $100. In a directional vertical spread, that ratio might be risking $200 to make $100. You pay for that extra probability with higher risk per dollar earned. Management style is the third differentiator. Vertical spreads are often binary. The trend holds, or it doesn't. You can roll them, but often you just close for a loss. Iron condors require more active defense. If one side of your iron condor is tested, you might need to roll the untested side closer to collect more credit, or roll the whole trade out in time. It is a more complex dance. If you want set and forget, the vertical spread is often more forgiving. Let's look at common pitfalls. A major mistake with vertical spreads is choosing strikes that are too tight. This increases your max reward, but lowers your probability significantly. You need room for the stock to breathe. For iron condors, the mistake is legging in, trying to time the market by entering the call side and put side at different times. This usually leaves you exposed to directional risk you didn't plan for. Enter the trade as a single complex order. Another nuance is skew. Sometimes puts are much more expensive than calls. In this case, an iron condor might be unbalanced. You might be better off just selling the expensive puts, vertical spread, rather than selling cheap calls just to make it a condor. This brings us back to the core philosophy. Do not trade the iron condor just because you want to feel active in a flat market. Only trade it when premiums are rich enough to justify the stress of watching two goalposts. So, here is your checklist for this week. Pull up a chart. If you can draw a clear arrow in one direction, look at vertical spreads. If the chart looks like a messy sideways chop and IV is high, look at iron condors. Remember, Both strategies are defined risk, which is excellent for capital preservation. But defined risk doesn't mean no risk. Always size your positions so that a max loss on any single trade represents only 1% to 2% of your total account. Ultimately, the vertical spread is a sniper rifle, one target, one direction. The iron condor is a net, catching price in a zone. Don't use a net when you need a rifle, and don't use a rifle when you need a net. Start small. Practice identifying which environment you are in before you execute the trade. The market is always speaking. Your job is to listen to the volume and volatility before you speak back with your capital. By mastering the distinction between directional bias and volatility trading, you stop gambling and start operating like a casino, stacking the probabilities in your favor regardless of the strategy you choose. Define your market view first, then select the strategy that fits.